Benjamin Graham, the author of The Intelligent Investor, is a legendary figure in the world of finance. He is widely regarded as the father of value investing. His investment philosophy, emphasizing intrinsic value and long-term growth, has influenced generations of investors. Born in London in 1894, Graham immigrated to the United States as a child. He went on to study at Columbia University, where he later taught and mentored another investing giant, Warren Buffett. Graham's investment journey began in the tumultuous 1920s. He experienced both the euphoria of the Roaring Twenties and the devastation of the 1929 crash. These experiences profoundly shaped his investment approach, leading him to seek out undervalued companies with strong fundamentals. Graham's strategies focused on minimizing risk and maximizing returns over the long term. His legacy continues to inspire and guide investors worldwide. Published in 1949, The Intelligent Investor is considered the Bible of value investing. The book has sold millions of copies and been translated into numerous languages. Its enduring popularity is a testament to the timeless wisdom it offers. Graham's masterpiece provides a comprehensive framework for making sound investment decisions. He emphasizes the importance of thorough research, understanding a company's intrinsic value, and investing with a margin of safety. The book is not just for seasoned investors. Graham wrote it for the everyday person who wants to take control of their financial future. He breaks down complex financial concepts into easy-to-understand language. The book's core principles remain relevant today, even as the financial markets have evolved. Whether you are just starting or a seasoned investor, The Intelligent Investor can provide valuable insights to navigate the complexities of the market. Value investing, the cornerstone of Graham's philosophy, involves identifying undervalued companies. These companies are trading below their intrinsic value, meaning their stock price is lower than what the business is actually worth. Graham believed that the market often misprices stocks in the short term. This mispricing creates opportunities for savvy investors to buy stocks at a discount. Value investors look beyond the current market noise and focus on a company's fundamentals. They analyze financial statements, assess management quality, and evaluate the company's long-term prospects. By understanding a company's true worth, value investors aim to purchase stocks when they are undervalued and hold them until the market recognizes their true value. Section 4. The margin of safety, your shield against market volatility. The margin of safety is a crucial concept in value investing. It acts as a buffer against unforeseen circumstances and market fluctuations. Graham advocated for buying stocks significantly below their intrinsic value. This discount provides a cushion to absorb potential losses if your initial assessment proves incorrect. Think of the margin of safety as a safety net. It protects your investment from market volatility and errors in judgment. By buying stocks at a discount, you limit your downside risk and increase your potential for long-term gains. The margin of safety is particularly important in uncertain economic times. It provides peace of mind knowing that your investments are protected from significant losses. Section 5. Mr. Market, your fickle business partner. Graham introduced the insightful analogy of Mr. Market to illustrate market fluctuations. Imagine Mr. Market as a business partner who offers to buy or sell stocks daily. However, Mr. Market is emotionally volatile and his quotes are often irrational. He may be overly optimistic one day and deeply pessimistic the next. Graham's point is to not let Mr. Market dictate your investment decisions. Instead, use his emotional swings to your advantage. When Mr. Market is overly pessimistic, he offers low prices for valuable companies. This presents an opportunity for intelligent investors to buy stocks at a discount. Conversely, when Mr. Market is overly optimistic, he may overvalue companies. This creates an opportunity to sell stocks that you believe are overvalued. By understanding Mr. Market's emotional swings, you can make rational investment decisions and capitalize on market inefficiencies.